Can you hear me now, Chico? Chico, comment back. It's been like I don't know, a month since I use this thing. So, can everybody hear me now? All right. Thanks, Mom. Thanks for commenting and saying that you can hear me now. All right. So I'm going to restart all of that since nobody heard it. And so what happened today was we were going to be getting news from the Fed on what their plans were in cutting rates or what they feel like the economy, and they're still giving testimony and everything is happening with that. And I'll give you a recap on that after I have a chance to watch it. I wasn't going to watch it live and bring it onto here because I don't know what kind of trademarks and what kind of stuff happens with that. So I just wanted to give a quick rundown on what happened and what that means for mortgage rates, what that means for the real estate industry moving forward, and what the plans are for the future from the Fed and the correlation between Fed and mortgage rates. So a lot of people, I've seen a lot of bad information when it comes to this on social media and really in news outlets in particular, making a direct correlation between the two of Fed fund rate and mortgage rates. There's not a direct correlation between the two of them. When the Fed cuts the Fed fund rate, it does not cut the mortgage rate. So when you see what they did today, which was they cut 50 basis points, which is what we anticipated them doing. That's not cutting the actual mortgage rates by half a point. So what 50 basis points is, if you don't know what that is, 50 basis points is a 0.5%. So 25 basis points is 1/4%. You get it. You understand. Everybody's good now. But they cut 50 basis points, a 0.5% from the Fed fund rate. But again, that's not a direct correlation to mortgage rates. That's not the same thing. It's just alerting the mortgage-backed security market and the mortgage market that they feel like they're starting to get inflation under control. That's the real litmus test when it comes to mortgage rates, is we want to make sure that we're getting inflation under control. So for the first time in 2 years, the rhetoric that we're seeing out of the Fed is they feel like they've got inflation going in the direction that they want it to go in, which is a great sign for mortgage interest rates. And if you've been to anything that I've been at and that I've spoken at over the last couple of months, you've heard me talking about this, which is when it comes to them cutting the actual Fed fund rate, on the mortgage side, we're pre-pricing that speculation in. So we've started getting news about this a month and a half ago, maybe 2 months ago, that they started kind of having this talk around, hey, when is going to be the best time to cut? They were getting a lot of pressure from the Senate and from the people that they were ultimately having to answer to whenever he makes these testimonies. And what ends up happening is we have to speculate to this on the mortgage side. So them cutting 50 basis points is not taking a 0.5% out of mortgage rates, and that's the biggest misconception that I see a lot of people making over the last, I would say, 2 months is, hey, I'm going to wait to buy a house until the Fed does what they're going to do because interest rates should be lower. When in reality, this started to price in about 2.5 weeks ago. And I'll show you a chart in the next couple of minutes that will show you kind of when that trend started, maybe a little bit longer period of time prior to that. But what ends up happening is when we start getting speculation that the Fed is going to start cutting rates or inflation starts coming down, what we have to do on our side is on the mortgage-backed security side, they start pricing accordingly based on that speculation. So if you heard me talking, I was very fearful of only a 25 basis points correction, because if it was only 25 and all speculation was pointing to 50, we weren't going to have a situation to where it was going to be positive. If they would have only cut 25, we would have seen negative price adjustments across the board on the mortgage side for the worse. We would have had worse interest rates starting right now moving forward than we would have had they cut 50. So they actually did cut 50. They did what we expected them to do, which is a great sign that they feel like that they have inflation starting to get under control. And one of the things that the Fed over the last few months, I would say probably last 6 months, was Once they start cutting, they don't anticipate stopping that cutting until they've cut at least 150 to 200 basis points out of that Fed fund rate once they feel like they have inflation under control. So now that they've made a cut as significant as 50 basis points, this is going to be a net positive on the mortgage side, because that is signaling to the mortgage business and mortgage-backed securities that they feel like inflation is under control and they need to start cutting before they start destroying the economy. The reason why they start cutting Fed fund rate is they don't want to put the economy into a complete standstill. The only power that the Fed really has, because they can't affect fiscal policy, they can't get into the politics side of it. The only measure of power that the Fed has is to affect the Fed fund rate. So they can't make us produce more oil. They can't make us do anything to battle inflation. All they can do is affect that Fed fund rate. So whenever they started increasing it, that was increasing because inflation was getting out of control and they needed to slow the economy down. And by slowing the economy down, essentially putting us towards a recession, if not putting us in the middle of a recession, which is what I feel like we are in right at this moment, that is the only measure that they have to get inflation down. And the mortgage side looks at that very heavily. So now that they feel like that they've got inflation under control, we should start seeing mortgage rates stabilize, more so over stabilized than what they've been doing, because we've been seeing some crazy swings over the last 2 years. We've seen some metrics where it's not moving to metrics that it would have typically moved to as far as mortgage-backed securities go. And it's just been kind of confusing. And it's been a world of unknown over the last couple of years with inflation increasing the way that it did. And it caused a situation that we have been in. So the positive here is that if you have had a situation where you've closed and your interest rate's over really 6.5%, 6.875%, and you've closed in the last couple of years, now's a good time to start looking at a refinance. It's not a bad time to look at it. Is it maybe the right time? I would say that for some situations it will be. Specifically investment property that you might have taken a pretty high interest rate during these last couple of years. It's probably a good idea to look at a refinance and look at the ability to get that down, especially with values increasing. If you go from that 80% LTV to 75% LTV with appreciation in the market, you're probably going to get into that next bucket to where your interest rate improves dramatically. I mean, I've got some that I've locked in some pretty crazy low numbers. Once they get into that next bucket from an LTV standpoint, especially on investment. So if you're looking and you are somebody that has an interest rate over 6.875, 6.5, you really need to reach out to a qualified loan officer, somebody on our team at Legendary Mortgage, myself, whoever. Now is a good time to get into that process. And with us specifically, we don't hard inquiry your credit report when it comes to a refinance. We're going to soft pull that. We're going to make sure the numbers make sense, and we're going to get you numbers out. And if it makes sense, then we pull the trigger and we hard inquiry. But until then, it's a net to where there's really no risk. But as far as, again, when it comes to the Fed, I've already seen, as I've been live, a really misinformed post. So just make sure there's not a direct correlation. There's no correlation between the Fed fund rate and what mortgage rates are. They are something completely different. So I did want to show you kind of how the mortgage-backed securities are performing after the Fed has announced that they are cutting the Fed fund rate by 50% or 50 basis points. So you can see here, this is the 5.5 that we're tracking here, and it's steadily growing in value over the last couple of weeks, starting at the beginning of August. Really towards the end of July, we started seeing that increase as that news started to come out that, hey, we're likely looking at a 50 basis points cut. We've steadily seen pretty good days over the last month and a half or so. So if you look at the 10-year Treasury, the 10-year Treasury is the metric that kind of foresees what the mortgage-backed securities are going to do. Right now, they're not moving in correlation to the way they typically would with the 5.5 being up, The 10 years up 2 basis points, and still we have positive mortgage-backed securities. What's likely causing that is a situation where there's positivity in the market. So the positivity is outweighing the fact that the 10-year treasury is up slightly. But as you can see, and same kind of correlation date as you see in the mortgage-backed securities, you have a situation to where July 29th, essentially, we start seeing a decrease in that 10-year treasury. And then again, you pop over here to the mortgage-backed security, the 5.5. You see that same gradual increase in that 5.5. So what I'm showing you here, when you see this number and it's 101.54, that's essentially what that mortgage-backed security is performing as, what it's paying out on when you invest into that. I don't want to overcomplicate it, so I don't want to get too crazy with it. So when you start seeing these numbers in the 101, 102 space, you are going to have a situation where you start seeing rates in that space, because every mortgage company has their general margin that they build into these loans. So a general margin might be somewhere from 2% to 4%, depending on the model that you're looking at, depending on what type of mortgage company that you're looking at. So when you start seeing things like 102 on this number, you're going to generally start seeing some rates that reflect that 5.5%, because there's enough profit margin there for mortgage companies to make enough money to offer that rate. So again, want to just show the direct correlation. You've got July 29th, you start seeing value being propped up in that 5.5 security. And then same thing with the 10-year treasury. July 29th is when you start seeing that rapid decline. And all of this is speculating what we just had happen, which was a 50 basis point rate cut from the Federal Reserve on the Fed fund rate. In the event, to draw a correlation, in the event that we would have only had a 25 basis points, because of all of the speculation that was built into this, it would have been a negative, because when mortgage companies lock rates, they lock those rates on a hedge. They're hedging on the bet that interest rates don't increase. But in a situation to where they decrease too rapidly, then you could have what's called a margin call. And on a margin call, you have to stroke a check for real money. And we saw this during COVID. We saw some of this stuff happen. And it's big money. So if you've got enough money hedged on locks, you might get a call from your broker dealer that says, "Hey, you owe me a check for $1 million by 5 p.m." And that's not a fun call to get. This happened to a lot of mortgage companies over the time period of COVID. And so whenever that happens, you got to write that check, or your broker dealer cuts you off and you can no longer hedge your rates, and you're essentially out of business. And so what ends up happening is, when we start getting this speculation on the mortgage side that the Fed is going to start cutting rates, we have to speculate that in, because on the off chance that they don't cut as much and rates go up, we're hedged, we're fine, everything's good. But on the off chance that they cut it more than what we anticipated, or we didn't speculate that in, now you start having margin calls, now you start having issues. So you've heard me say this. I wanted to provide a little bit more clarity to this, because on some of my market update calls, I've said, hey, listen, all of this stuff is kind of pre-priced in. I want to get a deeper look into that. It is pre-priced in, because we have to pre-price it in, because if it drops further and we have a rapid declining rate environment, all of these mortgage companies start having to stroke big checks, and that's not what they want to do. So as you see stuff come out, as you see news come out, if you're a loan officer and you want to know more about this stuff, as you see news come out, if it's positive news for mortgage rates, that stuff's going to get pre-priced in, rather than it happening on the day that it actually gets cut. I mean, as you can see, we're not having these large, massive green numbers on the mortgage-backed securities, because all of this stuff is just pre-priced in. So if you're a real estate agent in particular, and you're watching this and you're saying, well, what does this have to do with me? As a real estate agent, what can I use this for in order to educate my buyers? And what I would say to you is, get them off of the fence, especially if they're a first-time home buyer. If they are a first-time home buyer and they are on the fence and they have limited funds to come to the table with, they need to get in the game as quickly as they can, because if we get another 25 or 50 basis point cut in October or November and rates continue to decline on the primary residence side. I don't foresee them declining much on the investment side, just because of loan level price adjustments. They could be getting themselves priced out of the market, because what we will have is we will have more people offering on homes because people start poking their head out of the sand and saying, all right, now rates are at a place where it's a little bit more palatable. We have more people maybe listing their homes on the market because they have a situation where maybe they had another child, they hate their neighbor, whatever it might be, and they're sitting at a 3% interest rate and they just could never stomach going to 7. But now that 5's on the board, they're much more inclined to either list their house, buy a house, whatever it might be. So as agents, this is a great point to be touching your database. It's a great time to be touching people that may have went with somebody else that you lost to either selling their property, it expired, they sold with somebody else, they never rebought, whatever it might be. It's a great touch point to follow up with anybody and everybody in your database. And I would tell you that if you've got people in a database, there's gold in them their hills, over the next couple of weeks to a month, 6 months, because there's a lot of people that have sat on the sidelines just not being able to stomach the look of a 6, 7, 8% interest rate. So that's my advice. This is my little quick rundown. I've been on for about 20 minutes now. If you've got any questions, let me know. Jeremy, a good friend of mine, Jeremy Halpin, he said, good time for 2-1 buy down people to refinance because they're about to expire based on when you may have locked and when you may have closed. I actually have a friend that I'm helping with something like that right now. They've got, it was a 3-2-1 buy down. They had a situation now where it makes sense to refinance. There's about $4,300 left from that buy down that they can apply towards their closing costs. And it's a great time to get them into a better interest rate because it will ultimately adjust to a higher interest rate. So good point, Jeremy. And if you are somebody that ever closed on a temporary buy down, that's not handcuffing you. You're not handcuffed to that buy down. You can get out of that, and anything that was not used will go towards your closing costs on the refinance. So it's an important point to make. So if you took a 2-1 or a 3-2-1 buy down and the seller contributed towards your temporary buy down, now is a good time to look at that because that will go directly towards your closing costs, and it is a great benefit in that event. So Travis, my boy that brought me over to our parent company, Lower, thanks for the hands, man. Love you. If the road wasn't closed from Wilmington to Myrtle Beach, I would say come down and hang out with the team today. We got people in town, but yeah, I don't think that you could get down here in a reasonable amount of time. Heidi, thanks so much. Hopefully I helped somebody with this. Again, interest rates didn't move. Only the Fed fund rate moved. Don't play into the bad information on social media. It's great clickbait, but ultimately when somebody clicks on your post, if you're a realtor, and all of a sudden they were already pre-approved with somebody and they're ready to buy, and your post engaged them and got them excited about it, and then their rate's exactly the same because they got pre-approved early this week. It's just not a good feeling. It's not something that'll work well in your favor. So just be careful about that stuff. Share this with them if you want to share this with your clients. I'm happy to help in any way that I can. Appreciate you guys. I'm signing off. Hopefully everybody heard this and my audio came back. And Jake, what's up, buddy? See you in here in the comments. Yes, investors have already pre-priced this in, of course. Timmy Pierce, longtime client of mine, one of my best friends. Love you, brother. Chico, the one and only Chico, jumped on. He told me no volume. I love me some Chico Fisher. He is one of the best people on the renovation side I have ever worked with. He is fantastic on renovation loans, structuring them, all of that. And I often text him and ask him questions because he's amazing at it. Appreciate you, Chico. Jeff, thanks for commenting, Jeff. Of course, my mom is proud. Thank you, Mom. Love you. All right, I'm going to sign off. Thanks, guys. Share this with somebody that shares bad information. That would be awesome. If you see somebody sharing bad information, just share this link in their comments so you can help them get a little bit more educated on it. Boom, boom, boom.